Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing SoFi's stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 9.9 billion market cap. They're trading at $10.53 a share, and they have 940 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Lots of red, really big numbers. Negative $500 million in 2020, negative $1.4 billion in 2021, negative $7.4 billion in 2022, and negative $9.6 billion in the trailing 12 months. We're going to look at their financials later, so we'll dig into the numbers a little deeper. Net income is the profit or loss on the income statement. It's revenue minus expenses. In their case, it's interest income minus expenses. And that's negative each year. They did have their smallest negative in the trailing 12 months, negative $200 million. Revenue is the sales for the company, and that does go up from $566 million to almost $1 billion to $1.6 billion to $1.8 billion. So if a company has negative net income and negative free cash flow, you want to make sure their revenue is increasing. If their revenue is not increasing, that's a big problem. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $23 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $11.4 billion. We divide that by 940 million shares. And we get a calculated stock price of $12. They're trading at $10.53, so they're trading at a 13% discount. It's a buy according to the model. I did a video exactly 2 months ago. They were trading at $6.94. My value was $11.38. Look how close the stock price is to my target. It's now $10.53. The company did report their second quarter earnings yesterday, so my target is up a little bit from $11.38 to $12.11. There are 57 companies in the same industry as SoFi, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent $105 million in CapEx. Their debt to equity ratio is pretty close to median 1.1. They're at 1.2. This means for every dollar of equity, they have $1.20 of debt. They have the worst free cash flow, a huge negative. Most companies are positive. They rank 10th in market cap. The average is $23 billion. They're $6.5 billion. All their price multiples are worse than the median. Their price to book is better than the average. We can't look at their PE or price to free cash flow since they're negative. And their price to sales is a little bit worse than average. Their revenue is between the median and average. And we can't look at their 5-year annual revenue growth rate. We don't have enough information. They reported their second quarter results yesterday. They beat earnings and revenue. They expected to report earnings of negative 7 cents. That's negative 7 cents per share. They reported negative 6 cents. So that's a surprise of 14%. The revenue forecast was $473 million. They reported $489 million. That's a 3% surprise. Last quarter, they also beat earnings and revenue. Same thing with the quarter before that. Let's take a look at their press release for their second quarter 2023 earnings. They had record GAAP and adjusted net revenue for the second quarter. Revenue of $498 million, up 37%, when you compare that to the second quarter of 2022. Record adjusted EBITDA of $77 million, up 278%. EBITDA is earnings before interest, taxes, depreciation, and amortization. They added 584,000 new members, which is up 44%. They added 847,000 new products, up 43%. New products is always equal or higher than new member adds. It can never be less. Because if you get a loan through SoFi, you're a new member and you have a new ad. You added one product to that platform. But let's say your friend signed up to SoFi to get a student loan and a checking account through SoFi. They added one new member, your friend, and they added 2 new products because he's using 2 products from their platform, a loan and a bank account. Deposit growth of $2.7 billion. It's currently $12.7 billion in deposits. That's up 26%. Their management raised their full year 2023 guidance. They currently have 6.2 million members. These are their customers. And you can see that goes up every single quarter. It was 4.3 million last year. Total products, 9.4 million. That also goes up every single quarter. That was 6.6 million last year. Their lending products go up every quarter. It was 1.2 million. Now it's 1.5 million. Financial services products, like a money market account or a savings account, that went from 5.4 million to 7.9 million. Their technology platform accounts peaked in the fourth quarter of 2022 at 131 million. It is up quarter over quarter. It's currently 129 million. In this latest quarter, they originated 3.7 billion of personal loans. That's up 51% from last year. Last year was 2.5 billion. Student loans, 400 million. That's pretty much flat from last year. Home loans is down. It's 243 million. It was 332 million. The average loan balance is really small for personal loans, only about $24,000. Student loans, $45,000. Home loans, $277,000. That is down in every category when you compare it to last year. In terms of total products, total number of loans, it's up in every category. Nearly 1 million in personal loans, 500,000 in student loans, and 27,000 in home loans. On their technology platforms, 129 million accounts, up 11% from last year. Here's a breakdown of their financial services products. Money is their biggest. That's checking and savings accounts. 2.7 million products, up 47% from last year. Invest, if you want to invest in stocks, 2.3 million accounts, up 18%. Credit cards, 213,000. Referred loans, 47,000. SoFi Relay, 2.6 million. The purpose of Relay is so you can link all your accounts together. Your checking account, your savings account, your investment accounts. You can view everything in one dashboard. So total products, 7.9 million, up 47% from last year. Their guidance for the second half is 1.025 to 1.085 billion of revenue. That'll be an increase of 19 to 26% from last year. Full year guidance is about 2 billion of net revenue, which is up a little from their prior guidance. Let's look at their income statement. Most banks or financial companies make money from interest income. To give you a simple example, say you deposit $10,000 into SoFi's savings account and they pay you 1% a year in interest. So that's $100 a year in interest. SoFi takes that $10,000 and gives the money to me for a personal loan. And I pay SoFi 11% interest on that $10,000 loan. So I pay SoFi $1,100 in interest for the entire year I have access to that money. The way SoFi makes money is on the interest spread. Their net interest income is $1,000. $1,100 they receive from me minus $100 they pay to you. So the interest they received on loans is $442 million, which is a majority of their $470 million of interest income. They also have interest expenses. Remember the example I gave you earlier? If you deposit money into the bank, they paid $106 million of interest to the people who deposited money at their bank. They also get financing through securitizations and warehouses, because usually banks need more money than just what's deposited at the bank. The total interest expense is $179 million. Their net interest income is $291 million. So they took money deposited at the bank. They also borrowed some more money through warehouses, and they paid $179 million of fees, but they lent that money out to people who paid higher interest rates, and they generated $470 million of revenue of interest income. So they profited $291 million from the $470 million of interest they generated. They also make money through fees. Their biggest fee by far is loan origination, $103 million. They offer a lot of technology products. They made $82 million of fees. So non-interest income was $207 million. So that gives them a total net revenue of $498 million. In order to run their business, there are a lot of expenses. To maintain their platform, $127 million. Most of that expense is payroll, but they also have lots of fees, lots of technology fees that goes into that $126 million. They do a ton of marketing, $182 million. Cost of operations, all the other miscellaneous expenses, $94 million. General and administrative expenses. This would include the salary for its executives. So their total expenses to run their business is $547 million. Their net revenue is $500 million. So they have a net loss of $47 million, which is better than last year of a loss of $95 million. So their loss per share is 6 cents compared to last year of 12 cents. And they're adding shares. Last year they had 910 million. Now they have 937 million shares. Even though they have a net loss, an accounting loss of 47 million, they do have positive EBITDA, 77 million, which is 300% higher than the second quarter of 2022. The main reason is they had a lot of depreciation and amortization, 50 million. That's a non-cash item that brings down your net income, but we add it back here because EBITDA is earnings before interest, taxes, depreciation, and amortization. And that's this, depreciation and amortization. Their D&A increased from 38 million to 50 million, and they footnote it, number 3. And it says the increase in depreciation and amortization is in connection with acquisitions and growth in our internally developed software balance. If we were looking at EBITDA, we wouldn't see share-based compensation because it doesn't say EBITDAs, earnings before interest, taxes, depreciation, amortization, and stock-based compensation. It just says EBITDA. But they threw this word adjusted in front so they can adjust the EBITDA even more. So they add back 76 million of stock-based compensation. And that's why EBITDA is so high, 77 million. But stock-based compensation is dilutive. It increases your shares outstanding, but it doesn't affect cash flow. It's a non-cash item because they just give employees stock in a company. Let's look at their balance sheet. They have 25 billion of assets, up from 19 billion last year. A bank's biggest asset by far are the loans they provide to their customers, 18 billion. So when a bank provides a loan, it's an asset to the bank. The person receiving the loan, it's a liability on their balance sheet. They also have a lot of goodwill, 1.6 billion. So let's say a company was worth $1 billion according to their balance sheet. They had assets of 2 billion, liabilities of 1 billion. Assets minus liabilities equals equity, equals the value of your company. So let's say the value of a company is 1 billion and SoFi paid 3 billion for that company. Then they would have to add 2 billion to their goodwill. Goodwill is the premium you pay when you acquire another company. If you deposit money into SoFi's bank, whether through a CD or checking or savings account, that's a liability to SoFi. That's an asset according to you, but it's a liability for SoFi. They owe that money to you. They have 12.7 billion of deposits and 18 billion of loans. That's a little scary when you see loans so much higher than deposits. How did they lend out 18 billion? They only have 12 billion of deposits. Well, you could see it right here, 6 billion of debt. They needed to take on debt to fund their loans. Let's look at the equity section of the balance sheet. They raised 6.8 billion from selling stock, from selling their business, and they lost 1.6 billion from running their business. Accumulated deficit is a sum of all their prior net incomes. If this number was positive, it would say retained earnings, but when it's negative, it usually says accumulated deficit. If you want to take your due diligence to the next level, you could look at their assets and liabilities and also look at the yield on each. The assets are the money they lent out. They lent out 17.8 billion at a 10% interest rate. They bought 387 million of investments. These are probably things like corporate bonds. They received 3.7 million of interest, and they receive a 3.8% interest on those investments. Interest-bearing deposits is when SoFi deposits money at another bank. 2.2 billion in deposits, they receive 24 million of interest, and they're getting a 4.5% interest rate. So they receive 9.26% interest on this $20 billion. They also have 2.9 billion of non-interest earning assets. That's a total of 23 billion of assets. Now let's see where this $23 billion comes from. Because they have to fund these loans, they have to fund these investments with something. They received 2 billion from their customers who opened up checking accounts. They pay 2.5% interest. 7 billion of savings accounts. They paid 4%. Last year was 1.1%. Because rates were a lot lower last year. Time deposits like a CD, 1.7 billion. That's a little higher, 4.8%. Last year was 0.59%. So $11 billion of customer deposits. Then they have a warehouse facility to get more funds, 3.2 billion. They pay the highest interest on that, 6%. Securitization and other debt. So 5.8 billion of debt, they pay 5% interest on that. On this $16.8 billion they receive, they pay 4.25% interest. So their net interest margin is 5.7%. That's the interest they receive on this $23 billion minus the interest they pay on this $23 billion. If you put $10,000 into this company when they IPO'd in January 2021, you'd be at $9,400 today. That's a 6% total return. Right off the bat, your investment would have doubled to over $20,000. And it looks like the stock has been in the red for the past year. But it has come up a lot the past couple of months. Let's look at the company on Simply Wall Street, trading at $11.45, $10.8 billion market cap, up 23% this past week. They had really good earnings, up 79% for the year. Let's learn a little more about the company. They operate through 3 segments: lending, technology, and financial services. The company offers lending and financial services and products that allows its members to borrow, save, spend, invest, and protect money. They also offer personal loans, student loans, home loans, and related services. They operate through the Galileo platform that offers services to financial and non-financial institutions and brokerage services, as well as Technisys, a cloud-native digital and core banking platform with financial services customers. It offers checking and savings accounts, debit cards, and cash management products. They provide SoFi Invest, a mobile investment platform that provides its members access to trading and advisory solutions, such as active investing, robo-advisory, and digital asset accounts. Founded in 2011, headquartered in San Francisco. They list a few risks. They have less than 1 year of cash runway, volatile share price in the past 3 months, significant insider selling. Shareholders have been diluted in the past year. Here's where the stock has been trading since they IPO'd. So it looks like this was a SPAC because it started out at $10. Its peak was a few months after IPO, 26 in February 2021. It looks like its lowest point was at the end of 2022, under $5. But it's more than doubled since then, trading over $11 today. 16 analysts priced this stock and the average price target is $9. They say it's 24% overvalued. It looks like their revenue was lowest in 2018, $270 million. Grown a lot since then. It's currently at $1.8 billion. This is for the trailing 12 months. Their revenue forecast for 2023 is $2 billion. Next year, $2.5 billion. $3 billion in 2025. The CEO's salary is about $1 million. Total compensation, $13 million. His tenure as CEO is 5.5 years. In the past year, there's been a bunch of insider selling and buying. Over 50 million shares have been sold in the past year. A little over 2 million have been purchased in the past year. Most of the selling was by SoftBank. That's the large Japanese investment firm. Masayoshi Son runs that company. Half the company is owned by the general public, 36% by institutions, 10% by insiders, and 5% by public companies. Vanguard is the biggest shareholder at 7%, 70 million shares valued at $800 million. SoftBank owns about 5%. That's the 4.8% ownership by a public company. Right here, remember we saw public companies, 4.8%? That's SoftBank. They had 1,800 employees in 2020. That's more than double to 4,200 currently. And the ticker trades on the NASDAQ, Mexican Bolsa, and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.